One of the advantages I have of the horsepower of the managing partners and their years of experience and their cultivated relationships that they have in the investment community has afforded us to have, in some cases, exclusive access to what I'll call the alternative space. And that alternative space is made up of many, many different things, whether it's private credit, hedge fund, private equity, reinsurance, et cetera. These are, put simply for the client's perspective, non-correlated assets that most clients, in the traditional sense of having the 60-40 model, 60 stocks, 40% bonds, they don't really have any exposure.
Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Bryan Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Joining me today on this episode of the Active Advisor Podcast is Bradford S. Vannelli. Bradford is currently a partner and wealth advisor at Transcend Capital Advisors, bringing with him over 2 decades of experience in wealth management. Before joining Transcend, he previously held senior roles at both UBS Wealth Management and Merrill Lynch. Bradford specializes in financial planning, cash management, lending, and investment management for individuals, families, and business owners. That said, he holds the designation of Chartered Retirement Planning Counselor, CRPC, and is truly passionate about delivering a complete and personalized financial experience tailored to each client. Welcome, Bradford, and thank you for joining us.
Thanks for having me today.
I'm looking forward to today. I think we're going to have a really good episode. Now, before we dive into our conversation, I'd love to hear, in your own words, a little bit more about your role and what you're focused on today.
My role is, as a, quote, financial advisor, I attribute more to being a life advisor. I found in over 20 years that I'm able to help people with all sorts of facets of their life. Yes, finances is my main goal. And those are all the tools in my quiver, if you will, to help people through their finances. But I find myself being more of a life advisor because in this business, money is one thing, but there's also psychology and emotions involved as well. And I take people through very emotional times, whether they're thinking about retiring, educating a child, a death in the family, et cetera. Money creates emotion. And I think that that's not weighed upon enough in our industry. We do a great job of saying how we can solve the money, but I try to be a little bit more compassionate and use the emotional part as well to use the emotions and guide them through the money problems together.
Very well said. I like to think of financial advisors also as sort of a life coach. We're just kind of here to help you make sure you're doing the right things and staying in line and physically fit.
That's right. Exactly right.
That's awesome. Let's jump right in. Typically here on the Active Advisor, we like to get the conversation started by asking each of our guests, what is the first memory you have related to money or investing?
A very unique memory. And this relates to my father and my best friend. So when I was 12 years old, I've been into cars. That's my other passion in life since birth, basically. I've been into cars. And when I was 12 years old, I told my dad I'm going to buy a brand new car when I'm 16. And he said, well, that's going to be a challenge. You need this much money, et cetera. And I'm going back a few years, obviously, so not like today. But he said, I'll make a deal with you. If you can save $3,000 in the next 4 years, I will co-sign a loan for you to purchase a brand new car. Now, $3,000 at the time was an insurmountable amount of money in my mind, but I made a goal. Long story short, 4 years later, I had $5,000 and I got a brand new car that I ordered myself from the Ford dealer and literally purchased a brand new car with 12 miles on it myself with a car loan that my dad co-signed on. It was an awesome experience. And I was a little fearful at the time and I thought my dad was like mean because he wouldn't just buy it for me. But he taught me one of the greatest financial lessons in life. So I will never, ever forget that.
That sounds like an awesome lesson to learn. I've got to ask, what car was it?
So it was a 1991 Ford Escort GT. And it was black. It was manual. It had a power sunroof. In my mind, that was my Ferrari at being 16. So it was very cool.
No, I remember those cars. Yeah, they were cool. They were cool.
Yep, they were very cool cars.
I still want to say they still are.
Yeah, for sure. They are. In fact, I'll be honest, in the last 10 years, I've been trying to buy one, but there are none left. They went to the rust belt and they're all on the trash heap, unfortunately, because if I could find one, I would literally restore it and recreate my youth because there's something about that would just come back to me. And it's, I have beautiful cars now, but something about that first one is always special. So.
No, that's definitely it. We've heard a lot of different lessons and kind of memories on the podcast. And I think that's definitely one of the more special ones. That's one that always sticks with you.
For sure.
Going to fast forward here just a little bit, although now you've got cars stuck in my head. Love to hear a little bit more about your professional background and the journey that led you to Transcend.
So the background was actually pretty kind of aligned, if you will. I've always kind of been in finance from afar. I've been a worker. I've started working when I was 12 and I haven't stopped working since. And when I was in college, I started my own business and I actually named that business College Students at Work. And I self-marketed myself with flyers on mailboxes. And I offered services to basically incorporate odd jobs is what we do best. And we was the me, by the way. I didn't have a crew. And I would do anything that anyone needed. And I only marketed to what I thought were the wealthier neighborhoods. So I found myself in a very short period of time doing light landscaping, grocery shopping for people, running errands, etc. Long story short, I had some very, very successful clients. And one of those clients happened to be CEO of a company locally. I didn't know who he was. This is a gentleman that was worth probably $100 million at the time. And I had no idea who he was. Well, he came to me one day after he got out of his car that was driven every day. He had a driver. I had never met someone who had a driver. And he said, my wife really loves what you do. You work really hard and you help with the flowers and you help her with her errands and all this. He said, but I want to see what you would do in my world. I said, what's your world? He said, you have a suit. Of course I have a suit. He said, okay, he gives me his card and here it is. He's president, CEO of this company locally. So he said, I'd like to see you Monday morning at 10 o'clock. Okay. So I go to his office Monday morning at 10 o'clock. He owned the whole building, by the way, four floors of people, 300 employees. And again, I didn't know what I was even doing. And I went to the third floor and said, I'm here to see, Mr. Siegel. And they said, okay, your name. And I told them, oh, yes, he's expecting you. Okay. Here comes his receptionist or his associate, if you will. She comes out and says, come with me, please. We go into a conference room. And we sit in this big conference room. And I'm 20 years old. I don't know what I'm doing. And she said, so I've been instructed to give you a job. What would you like to do? I said, excuse me, I don't even know what you do here. Well, they were in the insurance business. So he owned a risk management company. He owned actually an insurance company. He had an agency, claims department, et cetera. So there's this whole conglomerate of insurance. And my father was in insurance for 45 years. So I kind of grew up in that world in the finance game. So long story short, that's how I started. I became a rotating intern for my entire college career. And I worked in 4 different departments all the way through graduation. They offered me a full-time job actually when I graduated, but I decided to take a different route. And I went into banking, was a mortgage lender right out of college. I have a degree in finance. So again, it's just kind of natural. And the lending was something I really enjoyed. I did that for almost 2 years. But what I hated about it was a transaction. So I meet you, we purchase a house together, or we do a refinance. It's wonderful. You're happy. I'm happy. Great. Are you going to call me again? Maybe, maybe not. I hated the transaction part. I love the relationship part. And the beautiful thing about being a lender is you have to show me everything. So I'm seeing your financial statements, your brokerage accounts, your retirement accounts, et cetera. That led me into saying, all right, I'm going to transition from being a lender to being an advisor. And I interviewed at anyone that would take me. And at the time, this is the late 90s, the dot-com run-up. This is 1999. Everyone is still hiring, of course, because there's no risk. And I got job offers from Payne Weber, from Merrill Lynch, from Edward Jones, from Dean Witter before it became what it is now. And I always held out for Merrill because I thought the raging bull, the thundering herd, as they used to call themselves. This is where I want to start. And I think everyone starts at Merrill, never finishes there, but everybody starts at Merrill. And that's how I started, basically. So I transitioned from banking as a lender to Merrill as an advisor, which I could still do lending. In fact, for years, I led with lending because I found that most people are willing to listen to you when you want to give them money versus when you're asking them for money. So that kind of helped me transition. So I would say my finance journey started kind of from day one, if you will, but from 20, having that internship in insurance, rolling into banking, and then going into advisory.
I can't say as a blame. I think Merrill's notorious for having a great training program.
They are, yes.
I've known several people that go through it. And so they were called the Thundering Herd, as you mentioned, for a very good reason.
Correct.
But one of the things, as you just mentioned, if we could kind of pull on that thread a little bit, is that people start there, they don't end there. So that leads me to believe that there's probably a great training program, a great foundation,
but a certain segment of that group, like yourself, looks to possibly spread their wings and maybe do something a little bit different. What led you to make the move over to UBS and then eventually independent?
What was interesting for me is that I stayed through the dot-com run-up, the slow markets of the middle 2000s, and then, of course, the great financial crisis. And I stayed through the acquisition by Bank of America, working for Merrill Lynch as it's about to go bankrupt. Literally coming home on Sunday nights, not knowing what's going on, reading CNBC going, Merrill's going out of business. And I'm like, wait, what? I had some experience then, but I wasn't super established yet, and I didn't know what was happening. And long story short, I stayed through the transition because I wanted to give it a chance. I loved Merrill. I loved what it was. I loved the culture. But B of A changed that rather rapidly. Within the first couple years after the acquisition in 9, by 11, it was not the same place. And I started getting frustrated. Just my managers changed. In fact, my regional manager, who had become a great friend of mine, kind of a mentor over 13 years, he had been at Merrill for 27 years. He left Merrill and went to UBS. He coincidentally decided to pick off our entire region here in local Detroit. And there were 17 of us from my Merrill office that went to the UBS office across this town, basically. So I followed my compatriots. I followed my manager because UBS, through the crisis, almost went out of business, the whole Paine-Webber thing, and they almost went under. And it was taken over by all former Merrill executives, and they turned it around. And UBS became Merrill Lynch Part 2 for me, if you will. And I had a very good, successful transition. I doubled my business in growth from 2012 through 2021, actually more than doubled my business. And I had a very good experience. UBS is a good firm. I'm not going to say anything negative about it, but like everything in life, they started to change as well. And whether it was a compliance issue or a management issue or whatever, this being put into a box as an advisor was really what led me to look at the independent channel. There was an opportunity, and I looked at everybody. I kicked all of the tires there were. I looked at the regionals. I looked at kind of supported independence. I looked at having my own shingle through total independence. That scared me because I need to have some support. But the idea of being independent really showed me that there was so much more out there than what I had at the Wires. The Wires did a great job of offering you a menu. That menu was 2 pages front and back, beautiful. What I didn't know was the menu is actually 12 pages. I just didn't see the other 10 because I didn't know about it. And being on the independent space, using Schwab as my platform, there's nothing that I can't do in the finance world. That doesn't make it necessarily better, but I have to have the opportunity and the choice. And the biggest thing for me was the fiduciary standard, which the wool was pulled over my eyes a little bit for the first 20 years of my career. Yes, we're fiduciaries. Of course, I've always acted as a fiduciary because it's absolutely the right thing to do, and you have to do the right thing for the client first. In fact, I had an old manager and said, here's the 5 things that matter in this business. The client, the client, the client, the client, the client. When you run out of fingers, you start counting on the other hand. And he's right. Well, as a wirehouse employee, Merrill Lynch, UBS, Morgan, pick on them, none of them are fiduciaries by the standard of the law. I didn't know that. I knew that, but didn't know that. And for me to be able to say now I'm an independent registered investment advisor and a true fiduciary is fantastic. It gives me a level of comfort. I think it provides another level of comfort for my clients as well. Not that I have ever acted not as a fiduciary, but now I formally am, and I'm guided as such and regulated that way with the SEC. I still have my broker's license, but that's a different story. So that to me was a huge opportunity. But again, more importantly, I think was the menu, right? The 2 pages front and back to being 10 now, using a simple analogy.
No, completely. I mean, I think it's like you mentioned earlier, it's having more quivers or arrows in your quiver, I think.
Exactly right. That can be overwhelming on the other side too, I will tell you. That's one of the biggest things that's hit me in the face. In 2.5 years of independence, I have learned just an absolute ton where it's almost too much, like a fire hose. Even having an investment partner, right? Where you think, okay, I know their menu. Oh no, I didn't. Because they have a whole nother menu that I didn't know was available. It doesn't necessarily mean that it's appropriate, but now truly being able to say, okay, Mr. and Mrs. Client, what is it the need we're trying to solve for? It is my responsibility to go really find the best in class at solving that particular issue or filling the bucket. And I think that is what the beauty of independence is. There's not the big box telling me what to do, guiding me. And I think that that is really, really advantageous for clients and being able to control fees as well. I have much more control from a fee perspective. Total transparency is also hugely important. There was stuff that was hidden in the wirehouses that is not hidden anymore. And I think that that's beneficial to my clients.
Definitely, without a doubt. I think I'd be remiss if I didn't ask. It sounds like some of the unexpected challenges may have been, like you said, drinking from a fire hose. That you find out kind of that the world is much larger than originally thought for a good portion of your career. Anything else, like once you kind of had the curtain pulled wide open, you're kind of like, whoa, wait a minute, what's going on here?
Yeah, the other difference thing and it was a learning curve for me to get used to the fact that I am a representative using the Schwab platform as my custodian, whether it be Fidelity, pick one, doesn't matter. I don't work for Schwab. Well, that took me a long time to learn because I was used to the fact that when I'm working at UBS or Merrill Lynch and a client asks me to do something, we're one in the same. I just do it. That's not how it works anymore. I call Schwab. I am simply connected to Schwab. I'm a representative, but I have no authority. I have no ability to do things that I used to be able to do for a client without signatures, which, by the way, ultimately is better anyway. You should have records and client full disclosure, et cetera, but I could do more because everything was together, right? Broker dealer, advisory, it's all one. Now it's all separated. Now I've managed through that process because I've learned how to do things and having standing letters and authority and that sort of thing. I'm a fully discretionary based advisor as well for managing money. But that was a huge learning curve that wasn't really explained to me before the transition process happened. I just assumed it's the same. Because of course, when my firm was recruiting me, if you will, don't worry, it's the same. It's not the same. And that would be one thing that as my firm grows and we get new colleagues that if they come from the wires, in fact, there's 10 advisors at my firm and 9 are from the wires. So that'll tell you something. That'll be one thing that we need to put in there saying, listen, you can get over it, but it's not the same. And I think that was the biggest thing, other than the fire hose of the opportunity, having the authority because of separation of things. That was the biggest change for me.
Like to actually pull on something you mentioned a little bit earlier. Going beyond the traditional approach, I think that's definitely what you seem to get from, and there's nothing wrong with that for a certain set of clients, from the wirehouses and even from some independents. But I think one of the things that you guys can do is really differentiated in a lot of respects is that you have the ability to offer, I'd say, the endowment model kind of investment philosophy versus some of the fellow independents that do not offer that. Would love to hear a little bit more about that and what you believe that that brings to your clients.
One of the main reasons I'm here at Transcend is the fact that my managing partners, and we are a true partnership, which is kind of a unique model in and of itself. We all own a piece of the firm. In fact, every employee owns a piece of the firm, which is quite impressive. There's 29 total employees right now. We're all in this together, right? We're rowing in the same direction. Well, one of the advantages I have of the horsepower of the managing partners and their years of experience and their cultivated relationships that they have in the investment community has afforded us to have, in some cases, exclusive access to what I'll call the alternative space. And that alternative space is made up of many, many different things, whether it's private credit, hedge fund, private equity, reinsurance, et cetera. These are, put simply for the client's perspective, non-correlated assets that most clients, in the traditional sense of having the 60-40 model, 60 stocks, 40% bonds, they don't really have any exposure. When you look at the biggest pools of money in the world, the endowments, if you will, the endowments or the general funds of either colleges, universities, even the sovereign wealth funds overseas, et cetera, they all have what's this endowment model, which means there's 3 sleeves. There's not just stocks, bonds, and cash. It's stocks, bonds, cash, alternatives. We have access to this alternative sleeve through just a myriad of different resources that I could never have had at a wirehouse because there's an alternative department at a wirehouse, but it's all based on size, right? So we would have the leaders of the world, Blackstone, BlackRock. There's nothing wrong with that, but you're talking about the 800-pound gorilla in a space where we get access to deals that are exclusive to us, and they might be $400 million, right? And we take down 20% of it as a firm. That's huge access. That can differentiate us from a fee perspective because we get pricing terms that potentially could be better for clients. And then the performance can ultimately be better as well. And we're doing the ultimate thing of diversifying the client's portfolio out, smoothing out the returns over time. That's the idea of the endowment model, trying to create more predictable, smoother returns over time. by having these non-correlated assets, right? I don't care what the stock market's doing when I'm looking at the alternative portfolio. I'm just worried about what is that alternative portfolio doing. And that, I think that's the key. When I talk to clients about building a portfolio, I attribute it to we're planting a garden. Something is always going to be in bloom. That's the goal, right? Some things will go dormant, but something will always be in bloom. This alternative bucket, especially with some of the vehicles that we have access to, allows us to do that. And I think that's the key.
I think being able to have something always in bloom is definitely a key differentiator, wouldn't you think?
For sure. For sure. You have something green to talk about on your statements all the time. Because let's be honest here, the markets don't always go straight up. They go up over time, but clients worry about what happened yesterday. That's the emotional part of the advisor thing that we have to get through. But clients worry about, well, what happened to me yesterday? They don't care about the fact that the Dow has gone from 5,000 to 40,000. They don't care about that. They care about what happened yesterday.
I'd love to hear if you have one. Don't mean to put you on the spot, but an example or story that you can share about the impact having this model at your fingertips has made for them.
Yeah. So at the end of 2022, we and the investment committee and my managing partners out of New Jersey put together a private reinsurance fund, which to me was completely new. And it was in partnership with a manager called Alias. And what was interesting is that reinsurance to me, okay, I understand the concept of reinsurance where you have these large companies, General Re, Aon, two of the biggest ones. They take risk from other captive insurers. For example, State Farm has 10,000 houses in Florida and they want to offload some of that risk exposure because of hurricanes. So they buy reinsurance. Well, 2022, most folks remember what happened in Florida. There's a little thing called Hurricane Ian, $109 billion in damage. So what did that do to reinsurance rates? They went through the roof. Well, there's a way through this very sophisticated product, which I understand enough of it to be dangerous, but some very, very smart people play the difference in the pricing of premiums because reinsurance bonds are only priced once a year. They're 12-month terms. They price in January, they mature at the end of the year. The pricing got so attractive at the beginning of 23, it was like the screaming buy of the century because of the damage that had been done. Now you're betting on that not happening again, right? Because if you have another Ian in 23, we got a problem because statistically speaking, the reinsurance rates are going to go even higher and we're going to lose money, right? But that just using very, very sophisticated models, looking at weather patterns, et cetera. In other words, I'm betting against the weather, right? The likelihood of having two of the Ian situations back to back was almost zero, right? And they hedge these risks, these bonds, these catastrophic bonds, as they're called, through interest rates, et cetera, and options. And they talked about the mean average return was looking to be about 20% for a 12-month investment. Well, that was a really neat thing to be able to offer people. Well, it did 29% net of fees. And in fact, all the clients that I put into that for 23, because again, it's a one-year term, I rolled that money again for 24 and then got additional clients. And then at the end of 24, we'll make a decision again. But being able to offer something like that, where I have clients joking at a cocktail party, I have investments in the weather. Wait, what? That has nothing to do with the S&P 500, obviously. And the fluctuation in value of this thing, it is flatline. It just goes up a little bit every single month. It's the most amazing thing I've ever seen because it's priced right, right? Now it's priced for perfection. Now we get a bunch of storms again, that may change again. But my point is right now there was an opportunity and my managing partners are always out there looking for these things. And I never would have brought that opportunity at a wire. There's no way because the size and the scale, it wouldn't have happened. It would never have gotten through compliance to be offered to on the retail level. And I think that is just one example of a really cool success story about something completely different that I could never have done before.
That is truly unique and differentiated and a value add to your clients.
For sure. For sure.
So it sounds to me, and I would love to hear your answer to this, but it sounds to me like just really servicing your clients and helping them out on this journey called life is really what motivates you.
Yes. My passion comes every day from being able to help people achieve their goals and to, we talked about this life advisor thing, to truly guide them along the way. I want to be the hub of the financial wheel in their life. And most people only pay attention to one part of their finances at a time. I really try to bring people into looking at everything, whether it's a simple budgeting, cash flow in retirement, allocation in their retirement plans, budgeting for saving for their kids, financing a new home, a vacation, doesn't matter. There's a million different things. And I tell people if there's a dollar sign in front of it, We need to talk about it. And I think that's what gets me excited because everybody is very different. Very different. I can tell you, I have 200 unique households and every one of them has a different story. And I think that's the cool. And what I've really been blessed with is that my client base looks very similar. They say that everyone flocks together, and that's true. I would invite all 200 people to my home personally for a dinner party, and I know that everyone will get along. That's the kind of business that I'm trying to run. And I like to think of myself as the advisor, as Thomas Stanley say, I'm the advisor to the millionaire next door. I play in the $1 to $5 million space. They're good people. They're hardworking people. They're not pretentious, and they listen to me. They value me. They will pay me. And I can go with these people for 20 plus years. I've now been around long enough where I've seen kids graduate from college. I've seen kids get married. I've unfortunately buried clients, right? And then have their kids. I just think it's really an amazing thing. I've become part of their lives. And when you get invited to a client's daughter's wedding out of state, it's absolutely amazing to sit at that table when you don't know anyone and someone will say, oh, hi, I've known the whatever for 20 years. Like, oh, I'm the family advisor. You're what? And then you get 10 more clients because they just think it's fascinating that why would I be there, right? I'm the nerd stock guy. Nope, I'm part of the family. And that's what gets me up in the morning and motivates me. And I just want to expand and help more people.
That's awesome. You mentioned previously that you love turning financial chaos into organization. And it sounds to me like definitely that's what you've done with a lot of the families and helped kind of bring them along on life's journey.
Yep. Totally. The chaos is real. I will tell you one quick example. I was reviewing a portfolio with a client at her home on a Friday afternoon. Her doorbell rang and the gentleman was at the door and she's like, oh my gosh, that's my date. I'm so sorry. I'm like, no problem. We're done. So, and this is a retired elderly lady and they were going on a date, which is super cute, right? They're in their 70s, both of them widowed and they're just, whatever, they're going to a movie or something. And well, it turns out he was a day early, which is even better. So I'm walking out and he's like, well, what do you do? And I'm like, oh, I'm Marlene's advisor. He's like, well, I need an advisor. You do? I ended up staying for another hour. This poor gentleman had money in 17 different locations. He didn't even know how much money he had. Within a month, it was all buttoned up in a plan. And we worked together for the next 15 years until unfortunately he passed away. But here's a perfect example of a man. He was fine, right? But he didn't even know what he didn't know. And he had done a good job acquiring assets, accumulating things, but he had no plan, no organization, nothing. He paid his bills and he figured it out. It was a mess. And I turned it into this beautiful, nice little, put a bow on it. And it was just amazing. All out of because I was there when he was picking up his date a day early. So you just never know how things are going to work out. And that's what I love about this business.
And I think it's special to hear on my side, just to actually hear that your clients do actually trust you and they really, want to actually work with you and show you everything. I think it's one of the biggest things that really kind of, at least you get, a much broader picture and can construct a better design portfolio and then kind of work with them on a deeper level.
Correct.
What are 3 common goals and how would you personally, I guess, help your clients march towards these goals?
I've been working on the same 3 things for about 19 years now. And I've actually stolen it from a very good friend of mine who's an author. He's a very well-known veteran in this business. His name is Don Connolly. He's been around for 45 plus years and he became a good friend over the years. And he simply said, what we do as advisors is 3 things. We want to educate our children. We want to minimize our taxes and we want to retire comfortably. And that just hit me in the face like hard because at the end of the day, that's what we're all truly trying to do. But we in the business, whether you're an asset management side or an advisor, doesn't matter. We love to make things complicated. And we have acronyms and we have this and we have allocation and we have managers and SMAs and ETFs. That's all great and fine. At the end of the day, what are you truly trying to do? Educate your kids. You're a parent. You're trying to educate your kids. You'd like to minimize your taxes, of course. Who doesn't want to do that? And then everyone, I believe, has this goal of retiring comfortably. Now, that might be on a beach. That might be retiring at your desk. It just depends on what it is that's important to you. But I found that whenever I've said that, and I say it to every one of my prospect meetings, they're kind of taken aback going, wow, really simple. Yes, it is. We do an amazing job of making it complicated. I try to bring them back to the basics, if you will, and then we go from there. Let me worry about the complicated stuff. But at the end of the day, what are your goals? There's 3. That's it.
Oh, that's great. I think you're 100% right. I think in this business, people have kind of tried to make things more confusing than it needs to be. And at the end of the day, it is that simple.
Yep.
Thank you very much. I have one final question for you. At Harbor, we're firm believers in active management, though it's important to acknowledge that every financial expert has their own unique perspective. From your experience, what is your take on active management and where have you seen it make the most significant difference?
Well, I am a huge proponent of active management. I have been for 25 years. And here's my simple reason as to why. I appreciate the cost is hugely important. Most, I'll say, index-based investments, ETFs specifically, the vanguards of the world, have built their entire business around the fact that they're low cost. That's fine. But what I can tell a client with a straight face every single time is that if you own an index, whoever's managing it, doesn't matter, pick one. You have guaranteed underperformance every single year going forward. And I just pause. Well, what do you mean by that? Talk about it. The market goes up 37%. You're going to get 37% less the fee. Oh, well, the market goes down 15%. You're going down 15% plus the fee. Well, that's no good. Okay, let's talk about this other opportunity here. Active management. Yes, it is more expensive, but over time, with the consistent manager, not every quarter, not every year, but over time, good managers that are vetted and have experience and track records have proven over time, net of their fees, higher returns, lesser lows. And I think that's the key because one of the most important factors that I try to focus on is it's not how much money you make over time, it's about how much money you don't lose. During the great financial crisis, the markets went down 54% peak to trough. My client experience was down 17%. That's terrible. I don't want to lose money at all. But guess what? The hole that I had to dig out of was a lot shallower than what people that owned the index. By the way, I could have charged double. I still would have beat everybody. That's my point on active management. I think that the media gives it a bad rap because cost is king. The good news is that cost is coming down for everybody. So active management is actually becoming more affordable. You have active ETFs now. You got a lot of different venues. Technology has helped bring down costs. So obviously much cheaper to trade stocks now than it was 25 years ago. I really believe that active management is worth the fee. Most of the negative hang up on active management is the fee. And I can just sell right through that because they add value, in my opinion, over time.
Last but not least, how can people find you?
Find me by calling my cell phone number. They can look me up online and LinkedIn.
Well, thank you very much. Now we're moving on to my favorite segment of the podcast, which is 60 Seconds with Bradford S. Vannelli. Let me know when you're ready. What's the best professional advice you've ever received?
Never stop trying. Nothing works, everything works.
Biggest risk you've ever taken?
Becoming an advisor.
Bucket list travel destination?
The Maldives.
What's the most unusual thing you've seen somebody do with their money?
Purchase a llama farm.
It never fails to make you laugh.
Seinfeld.
What's something you wish you were better at?
Eating more consistently.
What piece of advice would you give your younger self?
Work smarter, not harder. I was always the hardest working guy in the room, but I wasn't the smartest.
What's one question you think all clients should ask their financial advisor?
Ask about their experiences with their clients, whether that be returns, whether that be family situations they've solved. Ask about their experience and how they get into the weeds with their clients.
Most rewarding part of your job?
Helping people every single day and seeing their joy when I get them to their goal.
Favorite way to get active?
Trainer shows up at 7 in the morning, we work out.